So a very warm welcome to you all this evening, and on tonight's menu for discussion is liquidity. So various aspects of liquidity, starting from the risk, institutional aspects, markets, and regulations. And we have a very good lineup of speakers for you. So in terms of our topics, we have three key speakers today. So they are John Hatchett to my far left, James Walton, and Keating. John's the partner and head of corporate consulting at Hymans Robertson, and he specializes in providing financial risk management advice in relation to pensions. James is very much an investment strategy manager at L&G, and his work at L&G has covered a number of areas in the past, from hedging, direct investments, credit, and market risks. And Con's a very familiar face at Staple Inn, but for those of you who haven't come across Con's has had a very varied career spanning 40 years on infrastructure, ranging from infrastructure to investment managers for annuities to research analysts, and probably a lot in between. Con's currently advisor to a number of organizations, including OECD, on capital markets and pensions. And without further ado, I'll give the floor to John to open the talk.
So thank you, Parrot, and thank you everyone for coming this evening. I'm looking forward to hearing all your thoughts in the debates later. For those of you who have read the paper, you'll know it covers a wide range of areas, far more than we can hope to cover in just 20 minutes. So to try and set up for a good discussion, I'll give a high-level introduction to what we mean by liquidity, how people measure it, and some high-level implications, sharing a few of the working party's thoughts. James will then provide some comments on what this means for institutional investment strategy, a topic I'm sure close to many of your hearts, as well as looking at a few insights on markets and regulation. In our paper, and as a conclusion in our slides, we've suggested some questions which we hope are deliberately provocative, and looking forward to the debate later. I'm glad that worked, because our risk management plan was hope it works. It was not working very well earlier. So one sign that there's more work to be done in this field is a lack of common definition of liquidity. Since the crisis, one definition is looking at your investment portfolio and wetting your pants. I've got a 2-year-old son who's just going through potty training, so I didn't find that very amusing. As a working party, we've focused on having access to money and looked at this in a variety of contexts. Given where actuaries spend their time, we thought it worth pointing out early on that this is not a detailed guide to the matching premium in Solvency II, nor is it focused on managing liquidity of the asset and liability side of the balance sheet in detail. But we hope what we do cover will be of interest to actuaries working in those sorts of fields. We hope the definition and some of the corollaries on this slide are more or less straightforward. One point that is worth bringing out is the ability to trade an asset is typically related to how much other trade is going on in that asset or in similar assets. It's not related to the amount of issuance of that asset, i.e. liquidity is related to the flow of the asset, not the overall stock. At the bottom of this slide, we've highlighted 3 aspects which we think makes the analysis of liquidity particularly challenging. Firstly, market value and liquidity overlap. By that we mean, if we're struggling to sell an asset for a high price, is it because the asset is just not worth very much? Or is it because liquidity in the asset is low? And how do we disentangle those two effects? Secondly, if we provide others with money now in exchange for the promise of a return later, we're providing them with liquidity on the basis of our trust in their promise. Our expectations of future liquidity are implicitly tied up in granting credit, and so disentangling liquidity and credit is difficult. And thirdly, there's an operational aspect, which is that for most transactions, we can only access the money when the trade settles. Now, normally we don't think about this too much, and it's only highlighted in a settlement process when something goes wrong. Since we defined liquidity as access to money, we thought it worth at least briefly covering some time on money itself. Mervyn King said money is what people accept as money, and I think Bitcoins have highlighted that quite clearly. The government has a role here, both in terms of levying taxes and defining legal tender, which helps drive acceptance of what will be accepted as money. As people, we accept money because we trust that others will accept that money again in future, so it can act as a store of value to us. However, one of the reasons we need this store is because we just distrust others. We have trust in money, but we distrust that private debts of others will act as an equal store of value. And it's also far less useful as a medium of exchange. And finally, in a world where cash is king, liquidity provides us with insurance that will continue to have sufficient funds in order to meet our future needs for money. Liquidity itself is not directly observable, and it can manifest itself very differently in different markets and also at different points in time. This lack of direct observability means that lots of proxies have emerged. The most widely cited definitions up on the slides are due to the late Sir Andrew Crockett, who was former general manager for the Bank of International Settlements. However, alongside the many definitions of liquidity, there's an academic industry in trying to measure it. We found more than 80 different measures in the literature. Again, I think this is a sign that further research is needed to rationalise these and understand what's the most important and provide a framework for giving clarity on all this. A lot of the drivers of the liquidity of an instrument relate to information. Assets which hold their value well are typically more liquid. And holding their value means that their price is insensitive to news, in some sense. They don't change in value when new news happens. Simplicity, market norms, conventions are other ways which serve to reduce any perceived information asymmetry and also give investors greater confidence in the value of an asset. At a market level, active trading typically improves liquidity, although there are a couple of provisos that are worth mentioning. Firstly, you need the trading to be active when you actually want to trade. So I think high-frequency trading is an oft-cited example that can disappear actually at times of market stress when liquidity is most needed. Secondly, you need the active trading to be in the right size for the deals you want to do. If I think back to my actuarial studies, I'm sure I saw a spectrum of liquidity that looked something a little bit like that on the top. And it's a useful, simple model. But sometimes these models are interesting when they fall down. And we've got a list of a few examples there. So firstly, the full fall. On 15th of October this year, 10-year Treasury yields that morning dropped by about 20 basis points. And then over the course of, I think, about 6 minutes, they dropped by another 14 basis points. And a few minutes later, they went back up. So we saw a spike in what is typically perceived to be the most liquid market in the world. As a second example, I think it was within the last month or so, the CHAPS payment system in the UK that normally settles around $300 billion a day failed for around 10 hours. Amongst others, many people trying to buy houses that day were sort of ended up in the newspapers. And even though they had cash, they were still unable to meet their obligations. The third point there about asymmetric risks is the fact that assets or asset classes tend to improve in liquidity only relatively slowly over time. But as we know, market sentiment can change quite quickly, and actually liquidity can fall out of a market very rapidly. So there's an asymmetric way in the way that assets move along that spectrum. FX markets are also often called the most liquid of all financial markets. And at around $4.5 trillion, at the start of early 18, traded daily, they are really significant markets by any measure. And in particular, relative to the external liability global stock, that's an incredible flow. However, much of this trade is between dealer banks. Estimates of the trade in the real economy, trade and investment capital flows, are less than 2% than the overall trade in foreign exchange. So the liquidity flows in the market are very much different to the actual liquidity flows around the wider economy. Liquidity can be seen as a form of insurance. It's ensuring you have access to money in the future. And as insurance, it naturally comes with a cost. So we should be parsimonious with it. Academic theory suggests that left to its own devices, the private sector won't produce sufficient liquidity, or at least not a socially optimal amount. And so regulation of the provision of liquidity is well justified. Interestingly, looking at specific assets, liquidity has the property that it goes up with its issuance size. So the liquidity premium that investors will place on more liquid assets increases the more of that asset there is in the market. The final point I wanted to make, and I think importantly for actuaries, given the training we have, models which assess projects and rank projects purely in terms of net present value of cash flows largely ignore liquidity concerns. In the real world, companies and corporate treasuries in particular spend a lot of time focused on liquidity issues. And broader theoretical models show that institutions will rank projects in very different ways if they have a prioritization framework that considers and values liquidity as insurance. And I think we should ignore those liquidity strains at our peril. So that was just a brief potted summary of some points I wanted to draw out. Thank you for your attention, and over to James.
Thank you, John. So I'll start just by discussing liquidity's impact on institutions. This chart's actually from a previous working party demonstrating the liquidity transformation between assets and liabilities. The chart shows on the left liquidity requirements of liabilities, and on the right the offset against assets. So banks have liquid liabilities from depositors, lend longer, which creates an illiquid asset. So we see the arrow going from the top left down to the bottom right. Pension schemes and annuity books have long-term illiquid liabilities that cannot be traded easily for cash, and assets backing those liabilities are generally more liquid. So the rationale goes where liquidity of liability exceeds assets, there's potential to enhance returns through greater allocations to illiquid assets, and we see this sort of trend growing. But there are many reasons why institutions need or want liquidity, and not to match the cash flows in liability terms, just taking liquidity risk. They may not be able to do so, particularly at longer tenors where their assets aren't available. They need liquidity, obviously, to pay the actual liabilities. There's also a value on the ability to restructure a portfolio, and I'll expand on that more on the next slide. Liquid assets also let me participate in a market without investing in the fundamental research, which incurs costs. The kind of fundamental credit research that I would need to actually enter into an asset for its full term. So if I observe an illiquidity premium, how does an institution determine whether it's a buyer of it, essentially valuing the liquidity option? Well, quite rightly, most liquidity management is focused on examining marginal shocks to liquidity over short time horizons. For example, 1 day, 1 week, 1 month. And those are denoted in this chart at the top. So we rank assets from most illiquid to most liquid. An analysis and sort of demonstrating sufficient liquidity management is all about ensuring I have sufficient liquid assets to cover claims in the short term. If I'm decreasing the liquidity in my portfolio, I need to assess the increased risk of incurring losses as a result of that change and charge for that accordingly. In practice, pension schemes and insurers are often starting from such a liquid position they may charge little or have in place policies and management actions to limit this risk. So we pointed out in the paper that we really need to consider, in addition to marginal liquidity shocks, all other causes for sale of assets and the costs and benefits of doing so. As a long-term investor, I want to retain the option to sell assets before term for a number of reasons. It might be views on managing credit, regulations might change in future, or any other external trigger denoted by the arrows coming in from the right or up from the bottom, meaning that there's some value on that liquidity option. And each investor, each institution will place a different value on that versus what is available in the market. So as a very simplified example, how might I determine a liquidity charge, i.e. the extra yield I need on a liquid asset versus a liquid one? So we've gone through an example. If a pension scheme sponsor has a 2% probability of default per annum, and upon default, all my illiquid assets are sold to fund an insured buyout. Upon selling those assets, I incur transaction costs of 10%. Then on an expected basis, an additional yield to compensate me for that risk might be 2% times 10%, which equals 20 basis points per annum. In practice, there's other reasons to sell assets, and I want to allow for the dependencies between defaults and the cost of realizing them. But that's a charge that often goes unrecognized beyond the costs due to liquidity shocks. So to summarize the investor section, we have a continuum of investors ranging on the left to short-term speculators who have holding periods of days or seconds, right through to the right, genuine buy and hold holders of assets versus liabilities where there's no chance of sale. In practice, most investors lie somewhere between, and we've made the point that most institutions have to allow for the possibility they may wish to sell the assets in future, even if they're not obliged to do so, in assessing value of an asset. So I'll move on briefly to just make some observations from markets, particularly post the financial crisis. Just taking a step back, what causes liquidity to break down in a market? There's broadly two reasons: changes to uncertainty perceptions or change to risk and liquidity preferences. So in the example of uncertainty perceptions changing, that effect was documented by Akolov, referring to the second-hand car market, but it also applies to the MBS market in 2008. Essentially, buyers doubt the quality of an asset, sellers know they have good assets, and there's an information asymmetry there, and sellers don't sell because they're unlikely to be able to replace their asset with certainty. So there's an equilibrium with no trade. And liquidity breakdowns, again, we saw this during the crisis, are reinforced by a number of spiral effects. Capital based on credit quality or some market measures, using assets to fund on repo, as is the case with the MBS market. And in that environment, liquidity is hoarded rationally by institutions because that liquidity has more value. Shocks are more likely, and there's potential profits to be made from market dislocations, so that liquidity has value to me. Looking at some data throughout the crisis and beyond, this chart showing decline of the interbank lending market in dollars through time. It's really reflecting the adage, liquidity is fine until it's needed, which is well discussed and documented. We make the observation that liquidity did not transmit itself instantaneously or frictionally across sectors in the financial markets, which is often an assumption. Moving on to looking at actual asset classes, we observe that the turnover in many asset classes denoted in dollars has actually held up, to a reasonable degree. The left-hand chart showing 3 times turnover of Treasuries, MBS, and agency paper, and on the right-hand chart, municipals, investment-grade corporate, and high yield. As expected, there's been some decline in trading volumes in MBS and agency paper. Municipals has fallen off a cliff, but investment-grade corporates has held up reasonably well. However, bond trading is increasingly costly and concentrated, so turnover as a measure of liquidity is only telling one side of the story here. This chart is really demonstrating the decline in liquidity in the corporate bond market. It's a plot of turnover in billions of dollars against rank by turnover. Few credits are actively traded. That was true before the financial crisis, but it's become even more so as that very skewed distribution, whereby only the top 5 or 10% of bonds by size or by liquidity are actually being actively traded. And that's essentially largely as banks have withdrawn as intermediaries. The dollar stock in trading books has declined from around $260 million before the crisis to $50 million. Essentially, liquidity is moving towards treasuries and to lower risk assets. So I'm going to end by making some observations on regulation and policy, particularly since the crisis. We observe that without regulation, financial institutions will tend to minimize their holding in liquidity stores. But post-crisis regulations in various forms has been around encouraging low-risk liquid assets. But these minimum liquidity requirements, enhanced requirements at the institutional level, do not necessarily improve liquidity for the whole system if that liquidity is trapped within institutions. And the final point we make is really to contemplate the purpose of liquidity regulation. Economic benefit comes from increasing outside trade between the real economy and a market. There isn't necessarily any benefit just by improving liquid markets themselves if that liquidity is just from inside participants trading amongst themselves. So on that thought, I'll leave some questions which we wanted for debate, which may prompt debate. Thank you very much.
Thank you, John and James, for a very, very interesting talk on a topical subject. And it comes at a very opportune time, not least because of all of the discussions currently happening across the UK annuity industry on the successor of the liquidity premiums, the matching premium discussion. So a lot of people at the back of the minds are thinking about liquidity and seeing a holistic piece on the different aspects of liquidity is a very, very useful piece. There's some really useful insights I found, especially the different measures of liquidity and how they interact with each other. What was also interesting were your examples of liquidity failures in what were otherwise considered very safe haven and liquid assets, so treasuries, which was the wobbly Wednesday of 15th of October, and also the failure of the CHAP system, which is very scary if you think about it. And finally, it was also useful to see some of the liquidity changes in context before and after the crisis. So in particular, how the interbank lending has fared in contrast to kind of all of the different corporate bonds and fixed income instruments. It was really interesting to see that turnover in fixed interest has held up, whereas at the same time, interbank lending has completely crashed. So it was very, very useful as a context. On that note, hopefully it's triggered a lot more thoughts in the audience as well, and please feel free to have any questions or comments either on the topics listed on the slides or on any other liquidity related aspect.
Well, in the absence of questions, let's go there.
Well, I had a question just to kickstart the proceedings, just whilst the audience is having a think about it, and I'm afraid it's the very topical one on the solvency to matching premium. So I understand there's been a recent correspondence from the PRA again on the same day, interestingly, 15th of October, which talks about new rules new rules or new kind of thoughts on what assets are eligible and ineligible for matching premium. Do you wish to add anything to that in the context of what you have looked at on liquidity on a holistic basis?
I guess that's me. Well, I think those rules are around demonstrating you have fixed cash flows, and then if you chose to, you can have certainty around those cash flows matching your liabilities. My discussion around wanting the option to sell in future, I think, remains, but in a regulatory context, I think there's some uncertainty about exactly what that means in terms of demonstrating you're holding the asset to term.
Thanks, James. Are there any questions from the floor? Yeah. Louise?
Thank you, Louise Pryor. Many thanks to the authors for a really interesting paper. I have to say that this isn't an area I have much background in, and I found that it gave very clear explanations of some points. One thing I was very interested in is that you're obviously focusing mainly on the financial services sector and investments and so on, but there were a couple of references to the fact that liquidity is actually a really important consideration for what you might call ordinary corporates as well, because you referred to the fact that many of them have very, very big treasury departments. So they're really looking at liquidity from the sharp end. I mean, it's a day-to-day concern for them about whether they're actually going to have enough cash tomorrow, next week, to pay their outgoings. And I was wondering if you could maybe talk a bit more about that, or if you think that there are any insights one could get from studying that end of that part of what's going on in thinking about liquidity, rather than looking at the sort of financial services sector.
Shall I come in? The interesting phenomena that has occurred since the crisis is that the way in which most of the larger corporates manage their treasury function has changed. Prior to the crisis, it was perfectly normal to have your contingencies and reserves in the form of standby lines of credit, or committed lines as they were generally referred to. Since the crisis, we've seen a significant change in behavior, partly because when people went to draw on those committed lines, the material adverse change clauses were invoked, and there was some rather fine words exchanged usually. The response that we've seen, and it's one of the reasons that we've seen as much corporate bond issuance, is that corporate treasuries now will rather go out and issue the 7, 10, 15-year bond at these relatively low rates and sit with very, very high levels of cash, earning them next to nothing in their corporate treasuries. And that is probably the largest single reason why the corporate sector has as much cash as it has, which is surprising lots of people, but it's been a fact for rather a long time. And at the same time is even more indebted than it's ever been before. And that's true not just here, it's true in the US, it's true in lots of the European countries as well. No, I can't run my business if I don't have cash. And it's as simple as that.
Yeah.
I can't rely on standby lines the way that I used to, because when I really needed them, in a lot of cases, they just weren't there. So I now need to have lots of cash in hand. The easiest way to do that is to go and borrow at rates which are, by any reckoning, very, very low. And what's interesting here is we have high levels of indebtedness, very high levels of cash, and really very low levels of investment. Okay? That's the combination which seems to be driving the corporate sector at the moment. But you shouldn't expect to see the corporate sector actually investing until such point in time as they see demand for their goods and services, which basically means until Europe looks like it's going to pick up.
If I can just add to that in terms of what we can learn from it, coming back to the point on net present values, if you some of the early actuarial training, the way you think of a corporate doing decision makings is it would do some discounted cash flow calculations of the things that it would do with its money. It would rank them in order, and then it would do the top ones. But once you have a model in which liquidity is important, that's not the way you do the decision making anymore. You might do a project with a lower net present value because it provides you with cash when you need cash. And that's a completely different way of looking at the world. And although companies are borrowing at low rates, they're probably investing the cash at even lower rates. So that's a project, if you like, with a negative net present value. But in the real world, it's a very rational thing to do. And so I think there's more work for actuaries to do to understand how the liquidity dimension and the value dimension can be integrated in a coherent way. I think banks are trying to do it in the way they're modelling cost of funding, and regulators are trying to get to grips with that. But it feels like an area where there is more research to be done rather than there being a well-considered solution at present.
John Spain, that fifth question, the real economy over traders, the real economy has traders in order to make the real economy work. So I assume that the reference to traders is financial services, Del Boys. But the next question is far more interesting. The worst consequences of mark-to-market balance sheet management being mitigated. How about stopping using mark-to-market when it just doesn't bloody work? Sorry. Could you comment on that, please?
I don't think that's right, John. Mark-to-market works. It just doesn't have the effects that people wanted it to have.
That's fine. That doesn't work.
Sure, Gupta. We've all got so ingrained in our thinking that liquidity is a good thing that we rarely stop to think about the cost of it and how much is enough. And it's a bit like water. You know, we assume water is a good thing, which it is unless you're drowning. And I worry about the cost because it does operate at multiple levels, you know, affecting customers, institutions, and the economy. So if we start with customers, you know, we encourage retail customers to invest in liquid assets. And in fact, we make it very difficult for them to invest in illiquid assets. And that means many customers who are investing over the long term are giving up potential returns and having lower pensions as a result. Our regulatory, to reflect what John just said, our regulatory capital and accounting regimes are based on mark-to-market. And that drives life companies and pension funds to have liquidity requirements that are far in excess of their natural needs. And as a result, they contribute to liquidity shortages in times of stress and turmoil. But perhaps the issue that concerns me most is the impact of liquidity requirements on the ability of long-term institutions to invest over the long term and to invest efficiently. I was part of a Bank of England working party involved in a 2-year study looking into pro-cyclicality and asset allocation of life companies and pension funds. And as part of this, we thought carefully about how mark-to-market based regulation impacts long-term investment. And our work there left me with this concern. Liquidity drives volatility. It's a key driver of volatility. And volatility is the underlying measure of market risk used in mark-to-market based regulation accounting. But market risk is very different to investment risk. If I'm investing long term, I care about investment risk, and by that I mean permanent loss in the value of my investments. Whereas market risk reflects liquidity and volatility. And at the very time that market risk can be at the highest, investment risk can be very low. So in the middle of a crisis, for example, volatility is typically very high. But because markets have then fallen, investment risk can be very low. So at the time, I could and perhaps should be investing, our regulation and accounting is discouraging me from doing so. And of course, the opposite happens when markets are high. So I'm concerned that our focus on liquidity and volatility is in fact driving long-term investors to take precisely the wrong actions, and that's leading to procyclicality. So I do think we need to think carefully about how much liquidity is actually healthy. And I think the authors have done a really good service and are to be congratulated for their work and for drawing attention to this really important issue.
Can I come in there? I agree with the gist of what you're saying. The relationship between liquidity and volatility is complex. It's in fact U-shaped in the sense that extremely low liquidity can result in high volatility. Similarly, excessive liquidity will also result in extreme volatility. The thing to understand about this is liquidity has a cost. So if you are buying, the most liquid asset will be the most expensive relative to its fundamental values. Now, what that means is that the short term is actually operating to the detriment of the long term. By operating in short-term liquid assets, trading them willy-nilly, and increasing volatility, we are doing two things. We are driving up the price of that asset, which of course operates to the detriment of the long-term holder, where the income yield is critical. It's certainly critical in terms of long-term compound returns. The other thing that, of course, this is doing, and this induced volatility is doing, is it drives a wedge between the arithmetic return and the geometric compound return. 20% volatility, 2% underperformance in compound terms relative to the arithmetic. Those are the numbers. So is short-termism? Short-termism is much more pernicious than you might think, in the sense that it actually does harm to the long-term expected experience. Okay?
So to follow that up, Con, have we actually taken risk techniques designed for trading organizations and short-term organizations and applied them to long-term organizations?
Absolutely.
And in doing so, undermining long-term investment?
We've taken a short-term trading model, which was value at risk, and we're now applying it all over the place. And we are using cross-sectional ensemble statistics when we should be, for long-term institutions, be looking at the time serial. And that will give you very different sets of results. The chap you should read on that is Ole Peters at London Mathematical Laboratories and Santa Fe Institute. There are yet more problems associated with that. When you are talking about the long term, then you really are no longer talking about risk in this preventative sense, in this general insurance type sense. What you're talking about is uncertainty. Here. Now, what that means is we cannot identify the full set. There are circumstances likely to occur that we simply have no possibility of knowing what they might be. New inventions, for example. What you have to do in that circumstance is move from the static type risk management approaches that we have been using, and we have been applying those static approaches in things like LDI and ALM in the insurance industry, and setting all future in stone as if it could be set in stone today. And that is a major mistake. What we should be doing is adopting an approach which follows the precautionary principle. To this horizon, we can forecast with reasonable degrees of predictability. So let's make our allocations on the basis of that. What might that period be? It may be 3 years. It may in a life company be 10. But it's most unlikely to be 50 or 100. I don't know what the world will look like in 50 years. Well, I won't be here to see it, so I don't think I need to.
Colin have a question?
Thanks. Colin Wilson. I was just looking at your list of questions and maybe wanting to focus attention on the fourth one there, around does liquidity regulation enhance or reduce liquidity in the real economy? I think there are some hints in the paper that the answer might be reduce it. And I wanted to check that I'd interpreted that correctly. And if that is the case, then presumably that's not the intention. And what, if anything, can we do about it to seek to change regulation in a way which would actually deliver the most desirable outcomes, I guess. Maybe I shouldn't assume that's around increasing or decreasing in any sense. But I think I've interpreted it's around increasing in the outside, in the real economy, rather than worrying about the inside world, the market.
I seem to be answering all the questions. The problem with liquidity regulation is it requires liquidity to be hoarded within financial institutions. Once it's hoarded within a financial institution, it can't be available to the real economy. You have actually removed it from that. That means that either you have to do something to increase the velocity of liquidity outside of the financial system, or you have to increase the money stock or the liquidity stock in some way outside of the system. The problem, of course, with doing that is that you are running the cusp of an inflationary spiral in doing so, in doing either of those. It's a very tight line to follow, and central bank monetary policy in a world post-liquidity regulation will have to be very, very different indeed. And we have already passed the point. And if you look at US high-powered money, it peaked last June, and it's been declining ever since, largely because they've been draining through overnight reverse repo and the term deposit facilities.
So presumably, if you could rely on the corporates to continue to hoard the liquidity, then the banks could manage in a non-inflationary way in the way they wanted to. But it's the risk that they might actually, if you like, unhoard that and reintroduce it into the economy that's the real challenge.
If a bank has a statutory, a regulated liquidity requirement, and I go in as a corporate to call on my committed line of credit, he's quite likely to say to me, I can't give you this liquidity. I'm not allowed to. It's the role of banks as insurers of liquidity to the real economy has been decidedly compromised by this. I mean, Charles Goodhart has one way of expressing this in terms of taxis. This is the weary traveller who finally arrives on a train late at night in the middle of the wilds of Scotland. And he gets off the train and it's wet and it's windy and he's tired and oh, look, there's a taxi there, fantastic. Goes over to the cab driver and says, take me to this place 30 miles away. And the cab driver says, I'd love to, but the rules say there's always got to be a cab here at the railway station.
I think there's a parallel between required liquidity and required capital as well, and insurance companies have to hold more capital than their capital requirement to make sure that they don't go under their capital requirement, which does to some extent provide a lower risk promise to policyholders, but also restricts the way that insurance companies can invest, because they have to invest sufficiently defensively in a balance sheet sense to protect their capital levels, which goes to the point that Hatchett raised. And there has been a trend across particularly pensions in the UK of liabilities becoming more and more fixed in some sense, or turned into hard guarantees. And that, I guess, has some desirable attributes from an individual who doesn't want a benefit that's not guaranteed. But in the pensions industry, we've seen UK DB pensions essentially closed in the private sector, and it may take decades to run off, beyond the distance over we can see from a precautionary principle, but definitely decades. In insurance, it's pushed up the cost of guaranteed products and driven individuals towards unit-linked assets and towards there being a perception that that annuities are incredibly bad value, but they are the cost of providing it, a risk that I guess regulators and us as influence on those regulators deem acceptable. And in a liquidity sense, it is causing banks to hoard liquidity, which then causes corporates to cause liquidity, which then leads to a set of problems that we can see. And I think a lot of it is trying to drive risk below a level at which actually can be managed. And it creates more risk at a systemic level than allowing a system where failures are acceptable and a part and parcel of life, because you then get more upside as well as potentially having a limited amount more downside. But at a societal level, we're all better off.
I will just add one further point on that area. That's this idea that we are selling liquid securities to the consumer. This is true in the fund management area, but there are two sets of institutions which were specifically designed to sell illiquid contracts. And these are things like deferred annuities, life assurance. These are things like, I'm trying to think of another few choice examples. Well, pensions, I suppose, of the DB form. The deferred annuities and annuities may have been terribly bad value for money prior to Osborne's interventions earlier this year, but that doesn't stop them from being a near perfect form of security or investment design. We killed the wrong problem with Osborne's solution. The reason that things like burial societies and life companies and defined benefit pensions came into being was for a very simple reason. It couldn't be done in markets. If it could have been done in markets, there would have been no need for groups of people to band together and create these bodies, which is what they did. Now, where that leaves you, when you have this market-consistent nonsense, you are trying to force illiquid contracts, which were written for perfectly good reasons, i.e. the fact that markets couldn't produce them, into some form of market-consistent behavior. I mean, it's just nonsense. Their end of the rant.
Just one other point on making markets more liquid. John talked about what makes an asset class liquid, and norms and conventions and standardization is one thing. So that's an area regulators can potentially focus on in a market. That doesn't necessarily increase outside liquidity for outside investors, but can substantially increase the overall liquidity of the market, at least inside.
The most important characteristic of a liquid security is actually that it should be information insensitive. In other words, all hell can break loose, but you can still sell it. Now, think about transparency in that context. You come to some surprising answers.
There's a question on the floor.
John Dewey, you've made a very clear case that liquidity should attract a risk premium, and that I think potentially that premium should be time varying and vary across asset class. And at the same time, you touched on the potential investor appetite for liquidity. Have you done any work to quantify both the liquidity premium inherent in different asset classes and also risk budgeting or liquidity budgeting, the extent to which an individual investor of a given type in given circumstances can afford to take that liquidity risk?
The short answer to the first question is no. We've not sought to look at yields and try and disentangle which part of that yield might be an investor paying for liquidity insurance or not. There's a wide literature in that space that we've not sought to add to. On the institutional side, we've covered it briefly, and James talked about it a bit in the talk. And I think one of the things that you get to is that some liquidity requirements are marginal. So if you have a derivative strategy, you might do some modelling about how volatile will prices be and how much liquidity do I need to run that strategy without having to unwind it at some certain kind of confidence level, accepting uncertainty. So that might be kind of uniform across different investors. But then there are sort of idiosyncratic risks, such as if you're an investor who says, I will only hold investment-grade corporate bond, then you may need to sell a corporate bond if it goes below investment grade. To some extent, that's your choice as an investor. And then there are risks that you just need to sell, which will be very institution-specific. So if you're a DB pension scheme, the time at which mark-to-market bites in the UK is if your sponsor becomes insolvent, you need to liquidate your assets and pass them to an insurer, either as cash or in terms of gilts and are highly liquid assets. So at that point, your illiquidity gets pulled. But that's very much about your particular sponsor going bust, which is entirely idiosyncratic to you as an investor. And there may be other choices about investors who may move out of an asset class for ESG reasons or something else. But different investors may choose to liquidate parts of their portfolio for entirely individual reasons, which is why they will place a different cost of liquidity on themselves based on how they wish to approach the market, with, I guess, one extreme being someone who says, I will buy and hold, and I will not sell these assets under any circumstances, at which you kind of have no costs of having to realise those assets.
I will offer you one question, if you like, in response to have we done work on quantifying. The answer is I have been doing work on that since we wrote the paper. And one of the questions which then comes up is liquidity currently is by design as a result of quantitative easing and the lovely Mark Carney's actions as cheap as it has ever been. That has been the entire purpose of this exercise. Now, in that world, should you be buying the most liquid, which is now at an all-time cheap level, or should you be buying the most illiquid, as most insurance companies seem to be chasing? There's a second element that needs to be considered if you're going to look at pricing liquidity. You have to see it in the context of the term structure and the simplest understanding of what a treasury yield is telling us. A treasury yield of 2% tells us that liquidity in the future at the maturity of that bond is going to be very cheap. A treasury yield of 10% to that same yield tells us we expect it to be very, very valuable. That's what yields actually tell us about. Okay? Can you go off and price this stuff? Yes, but it's very, very difficult indeed. I mean, largely because you don't know what Mark Carney's going to do.
John Instance, can I just develop a couple of points? I think Ashok first mentioned it, and you did, Con, about the sort of individual's propensity or love of liquidity in terms of investing in cash ISAs, maybe as a result of George Osborne's pensions changes, switching out of DB, a highly liquid DB, into highly liquid DC and taking the cash out. I mean, do actuaries, I mean, I think this paper is very useful actually to raise this issue of the price of liquidity. I mean, what sort of role do actuaries have to educate and inform people making very significant decisions in terms of, and very potentially very expensive decisions?
The cost of holding cash to the individual certainly has a love of cash. Isn't it nice to pull the suitcase out from underneath the bed and look at it? What can you do about it? This is partly a question of consumer education. Actually, if you really want to bring it home in a hurry, when a cash ISA matures, you should just say, had you put this in national savings, it would have been worth this much more. Or you can choose whatever your favourite alternate is. But will people go that way? Probably not. You can probably affect some at the margin. But, distrust is the root of all money. And that's rather an important line. We've stolen it from Nobi Kiyotaki and John Moore, but as long as the consumer is distrusting, they will hold on to cash.
Unless it's residential property.
It's Kenneth Donaldson. On your last question, money creation, Martin Wolf got a bit of publicity earlier this year, the chief editor, economist of the FT, suggesting money creation was too valuable to be left at the banks and should be taken back by the government. I can't really see that happening for a very long time. And you cite Professor Werner in your paper. He also has some interesting ideas on reshaping money creation and disabling the banks from making certain fairly sweeping types of investment. I wondered where you were on money creation or whether or not you think the current system is the least bad.
Do you want to take that or shall I again? Go ahead. Where am I? Money creation generates seigniorage. It was a huge topic of discussion. Sorry, that was reading squabbles at the time of the creation of the euro. Do we really want to allow seigniorage to be captured by the banking system or by the non-official body? That's what the question really comes down to. As long as, I think the answer is you are prepared to, or we should be prepared to tolerate money creation outside of the banking system because it's distributed money creation. Okay. Yeah, if these were unitary banks just with a head office in London and no distribution capacity across the country, it would probably be a very different kettle of fish. But as long as this is legal tender and valid in payment of taxes, then it's probably okay. What you can't have is bodies creating a separate unit of account. Okay? The function of money that matters more than any other is money as a unit of account. All of the others follow from that. If you allow money creation in a way where you lose the seigniorage and you begin to damage the value and the consistency of money as a unit of account, then you have a problem. Would I allow something like Bitcoin to be called money? No. Okay. Could Scotland have used the pound sterling as its currency? Yes. And there's nothing that the Bank of England could have done about it. Nor should there have been any reason for the Bank of England to worry about it. The fact that there would then have been a supply of Bank of England notes in circulation in Scotland could have just been laughed at by the boys in Treasury as yet more seigniorage coming in.
I guess one could argue that money is whatever enough people agree to be a medium of exchange. So if enough people agree for Bitcoin to a medium of exchange, then it is money until it breaks down.
Money has to possess all of the properties, not just one. What you're describing there is a partial money, a quasi-money.
The problem I have with mark-to-market for long-term entities is that short-term movements just don't give anything like a reliable estimate of what's going to happen over 10, 15 years or longer. And that leads me actually to conclude that the discount rate which we've been using as a mechanism for over 200 years has probably passed its sell-by date. It's the sort of thing which liquidity premium would never come into. You just couldn't say, right, at 0.2%, we've done it. We've solved the problem. We should be looking at forward projection and taking into account projected cash flows, assets and liabilities, stochastically, as intelligently as we can, and no longer, at least in the DB environment, just looking at mark-to-market and 1.5%. When index-linked gilts were first issued, and what's that, 30 years ago? Something like that, 1981? I can't remember anybody saying, and we do expect yields to go negative, which is what happened. I think we need to rethink, not just in terms of liquidity, but everything else. We've got to change what we do as a profession.
I have a lot of sympathy with those views, and it does trigger another question. So we talked, I know Colin Wilson talked about the impact of liquidity regulation, but what also what one wonders about is impact of other unintended consequences of other regulations. So, for example, if you mandate annuity funds to invest only in a very certain pre-prescribed type of assets, does that unintentionally have impact on the liquidity aspects of everything you can and can't invest in? And is that something that had been thought about prior to the regulations coming in place? I don't know if you had views on that.
But I'll come back first on John's point about mark-to-market. There's nothing intrinsically wrong with mark-to-market, John, if those market prices reflect fundamental values. The problem is that they don't. And the reason is that those securities which are most liquid are those which are furthest from fundamental value. They are those which are most prone also to herding and all sorts of momentum effects and so on. Now, that creates problems. And that's the nature of the problem with mark-to-market. The volatility that you're looking at has nothing to do with changes in the fundamentals. It has almost everything to do with the game against others, where I'm trying to beat John or you or someone else in the market. And that's endogenous volatility, and it's probably 80 to 90% of the action that we see. This is why when you look at very long holding periods where that sort of action has simply smoothed out, you come down to long-term volatilities which are 2%, 3%, 4% perhaps, but more or less the same as they should be as the volatility of the economy, as the volatility of GDP. I mean, at the end of the day, it's only what's produced in GDP that can turn up in investment returns. I mean, you can have some variation between labour share and capital share, but overall they're going to be the limit. It's quite clear, it's GDP growth.
I think the point I'm trying to make and didn't get across is that mark-to-market, which takes account of volatility which is irrelevant to long-term entities whose managers, trustees can soak up the volatility without worrying over long periods, actually can lead and has led to huge misallocation of resources within corporates to their pension schemes, which seem to be in very little better shape on conventional measures at the moment than they were, say, 6 years ago, at the expense of investment, at the expense of jobs.
I'll come back there, John. Look, John, it's not mark-to-market that's the problem. It's basing actions on it that's the problem.
So I think that observation was more around rates, but there are, in insurance, in solvency matching adjustment, that's effectively a mark-to-market of credit, but also on the liability side to effectively cancel that out. I've been working in the US recently, there's book value accounting there, but mark-to-market when the credit gets really bad. So in credit space, there is a sort of mixture of mark-to-market and non-mark-to-market to allow for that. I think your observation was more around rates.
So I agree broadly with the limitations that you identified. I think with a DB pension scheme, the incidence of sponsor failure is not that low. It is low, but it's not that low. There are hundreds of schemes that have been through the PPF and more that have been PPF solvent and bought out. And in that tail risk, you do have to liquidate your position. So there's a funny dynamic where sort of 90% of the time we're investing over the next 20 years, or maybe it's 99% of the time, depends on your sponsor, but there's this tail risk where some of the time we have to sell all our assets in a very short period. And I think you need to understand both of those aspects to decide how much weight to put on mark-to-market, but it's probably not zero, and how much weight to put on a stochastic model over the long term to understand the volatility of cash flows you get from your assets and how they pay liabilities over time. Just coming back to Parrott's question about regulation driving asset allocation, one of the things that's been on my mind recently is you've seen academic studies by people at the Bank of England and others looking at how the regulatory climate for DB schemes has led them to buy gilts, driving down yields, which has created deficits, which has led people to think we better de-risk, so we'll buy more gilts. And there aren't enough gilts around. There aren't enough long-dated gilts. So you have to take a systemic look at what regulation is doing, because banks want some of these gilts to manage repo and manage their liquidity. And I mean, if you were very cynical, you may say from a government perspective, all these people lowering the government's cost of financing has some attraction.
If I can just add to that a little bit, as Con said, it's the unforeseen consequences of mark-to-market and its impact on asset allocation. One of the things that's struck me out of the Bank of England work was the extent to which there's been de-risking, both within DB pension schemes and with profit and annuity funds. And the de-risking that's taken place is way beyond what you'd expect from natural scheme shortening, etc., duration, etc., etc. For example, I think I'm quoting from memory, but the allocation to equities of the DB pension sector between, I think it was the years 2000 and 2011, fell from something like 70% to 35%. And that coincided with the introduction of FRS 17. And we saw similar results. You compare that to local authority pension schemes, which weren't subject to mark-to-market, they fell from 70 to 60%. And we saw similar things in with-profit funds. And one of the things that struck me was maybe what we're seeing is people rebasing their risk appetites so that pre-mark-to-market, they tried to pitch their risk appetites at the midpoint of the cycle. But with mark-to-market, they had to rebase their risk appetites to the bottom of the cycle, because otherwise you have to sell assets in a falling market, which is pernicious. So I think one of the consequences of mark-to-market may have actually been a rebasing of risk appetites to the perceived bottom of the cycle. The other unintended consequence, I think, of mark-to-market is herding. And one of the things we identified, particularly in the DB pensions world, is massive degree of herding. And that really came across in looking at, we did a little study on the impact of the index-linked market. And we found that the actions of pension funds had led to a suppression of the 20-year index-linked gilt yield by something like 165 bips. And the actions of life companies led to suppression of index-linked gilt yields by 74 bips. And so all of that, in turn, increased deficits, which led to more purchases of index-linked gilts, led to even higher deficits and set up a vicious spiral downwards. So I think the actions it's these unforeseen consequences that can actually be quite damaging. I sent the paper to an Australian friend who came back with a wonderful quote, which is an old Turkish proverb. And it went something along the lines of, all lemmings are irresponsible, but no individual lemming has ever been found to be individually incompetent.
That's interesting, and it reminds me of something we talked about in our paper, which goes back to the work of Keynes, which said there is no such thing as liquidity for the market as a whole. The most liquid asset is central bank reserves, but if we had to sell all other assets and convert them to central bank reserves, we would have to shrink the entire asset base of the UK down to the level of central bank reserves.
No, it's all right. Houses would be cheap.
Yeah. So it just sort of highlights the fallacy of you can drive liquidity so far, you can drive mark-to-market so far, and if you keep pushing, then you get pernicious and deeply undesirable systemic consequences.
Ashok, your Bank of England paper found only very weak evidence of pro-cyclicality in pensions and insurance world. And in that you are in common with Boone, Briere and so on. Going back to our topic this evening, which is liquidity, I will suggest to you that those findings now are out of date, largely because, and if only, we'll just blame it all on its own, EMIR coming in will require the maintenance of high quality collateral by insurers, pension funds, everybody. The collateral flows, the liquidity flows, and collateral is just a form of liquidity, could be enormous if we were to see another crisis-type meltdown. I mean, they're going to be big enough anyway that they're probably on the margins of manageability, But yeah, there's room for an enormous business here in collateral management under these regulations. And quite honestly, the sooner we kick the regulation out, the better. But yeah, that ain't going to happen very soon.
If I can come back on your first point about the weaker evidence of pro-cyclicality. The thing I found working with the Bank of England is they set the bar for evidence incredibly high. So it's a bit like proving global warming. You'll never get consensus view that global warming exists and these are its causes. So what we did find was enough evidence to say, yes, there is a real problem here. And the Bank of England wouldn't have published the paper if it didn't find, if it didn't really believe that there was an issue here. There was certainly some statistically significant evidence of pro-cyclicality, and that's quite a high bar. We didn't look at derivative usage. We felt that had we been able to look at derivative usage, we'd have found more. Yeah. There was a lot of anecdotal evidence, but perhaps the strongest evidence we found of pro-cyclicality was the heavy use of regulatory forbearance. Because you wouldn't have actually had regulatory forbearance if you didn't have the pro-cyclicality to begin with. And, you know, there are big flaws with regulatory forbearance insofar as you have to assume it'll never happen. So you have to work on the basis it won't happen, and it's all ex ante. You know, you need. Sorry, it's all ex post. You need ex ante tools. Sorry, I've got that the wrong way around.
Actually, I love the idea of that sort of regulation. I'm going to write regulations so they need me.
But the point I would say is that there was clear evidence, and if you look into the detailed findings in the paper, you'll see that there's a lot more. But it's quite difficult. It's a very high hurdle to get the Bank of England to sign off a paper saying there's clear evidence. They tend to use the word may when they mean will.
Yeah, just expanding on those cyclicality points, I think from work I've been involved in, you only really lose on credit historically when you invest at very tight spreads and then defaults emerge over the next 10 or 20 years, rather than investing at average spreads and you get a period of distress. And it's quite difficult to deal with that reality through a lot of sort of capital credit models. And so one thing that we've done at my firm is to charge essentially for downgrades rather than just a long-term buy and default haircut. So you're allowing for the fact that assets can downgrade, you'll need to hold more capital and you demand a return on that capital. And so it's just about charging in the right places to be able to then have a framework which you can take action to avoid pro-cyclicality.
I think that's been a really good discussion, so I'll try and just bring it to a close.
Actually, I will just say one thing.
Please
having published the paper, everyone's got all of our emails. If there are questions, just send them to us.
So yeah, it was a very interesting debate after the talk, which touched into pro-cyclicality and various aspects of regulation. And there's also a lot of interesting insights into the Bank of England paper on pro-cyclicality. On that note, I remember reading that paper and looking at the history of the asset allocation for with profits funds, and it was around 2003 when it started declining. Very coincidentally, or perhaps not, that was also the introduction of market-consistent regulations in terms of the prudential source book. So I'll leave you to make your own conclusions, but it was not, I don't know if it was statistically significant, but it was certainly very, very coincidental. But other than that, I think all I need to do is thank the speakers very much for very, very interesting and varied talk, and we should do that in the usual way.